Hello students, this video discusses learning objective 4 for chapter 7 regarding tax credits. Tax credits can be either refundable or non-refundable. They reduce tax liability dollar for dollar, whereas deductions reduce taxable income dollar for dollar. So credits are usually better because it will benefit taxpayer more than tax deductions. Refundable tax credits are refunded to taxpayers of the difference when gross tax amount less than tax credit. Non-refundable tax credits can only reduce the taxpayer's gross amount to zero, and any remaining tax credits are not refunded. Here are some of the examples of whether they are refundable or non-refundable. Number one, child tax credit. This one is partially refundable. Taxpayer may claim a $1,000 credit for each qualifying child. The credit is subject to phase out based on the taxpayer's AGI. This one you may want to see Exhibit 7-A on page 7-26 for the phase out threshold, and example 7-20 on page 727 for an exercise. Number two, child and dependent care credit is tax subsidy to help taxpayer pay for costs of care for dependents under age of 13 or physically mentally disabled, so the taxpayer may work or look for work. The least of the three amount is a credit. Number one, total annual care expenditures. Number two, $3,000 for one dependent or $6,000 for two or more dependents. And number three, the taxpayer's total earned income, the lesser earning spouse's income, to be specific. This one, please see example 7-21 on pages 7-28 and 29. So we're going to look at exhibit 7-9. Here are some of the conditions of child and dependent care credit percentage. So we also want to talk about education credits, partially refundable. Has several names such as the Hope Scholarship, the American Opportunity Credit, or AOC, that replaces the Hope Scholarship, or the Lifetime Learning Credit. Congress intends to use these credits to encourage higher education attendance by reducing the cost of attending college. Taxpayers must file joint returns to take these credits. The maximum AOC, or the American Opportunity Credit, for 2014 is $2,500 each dependent or individual. So please check whether the amount has been increased or decreased in the year that you are learning about this American Opportunity Credit. And also, this credit is subject to phase out. For 2014, 40% of the taxpayers' allowable AOC, anything needed to attend college for the first 4 years, is refundable. This one you want to see example 7-22, 24, and 25 on pages 7-30, 31, and 32. So let's look at this example 7-22. Courtney paid $2,000 of tuition and $300 for books for Ellen to attend the University of Missouri, Kansas City during the summer at the end of her freshman year. What is the maximum American Opportunity Credit before phase out Courtney may claim for these expenses? Answer is $2,075. Because the cost of tuition and books are eligible expenses, Courtney may claim a maximum of this AOC before phase out. So here we have 2,000 times 100% plus the 2,300 minus 2,000. Anything exceed 3,000, that will give you 25% based on the table that we discussed earlier. And also there is a tax table to determine which percentage will be phased out. Also, we want to look at this other example. Assuming Courtney qualifies for a $2,075 American Opportunity Credit, she is married five jointly and her AGI is $162,000. what amount of American Opportunity Credit would she be allowed to claim after phase out? So let's look at this one here. ALC before phase out will be $2,075. Her AIG is $162,000. Phase out threshold is $160,000. So there's a excess of age of $2,000. Phase out range for taxpayer filing married jointly. So it's a $180,000 minus $160,000, so you get a $20,000. Phase out percentage will be 10%. Excess AGI divided by the phase out range. And so phase out amount will be $208. Use $2,075 minus $2,008. That will give you the amount allowed to be claimed, $1,867. Lifetime learning credit. The lifetime learning credit will exclude books, but not limits on how many years to attend higher education. It's definitely non-refundable. The amount is 20% of all eligible expenses. The maximum is $2,000 a year, regardless of whether taxpayer pay for one or multiple dependents. So limit to only $2,000 a year, regardless how many dependents a taxpayer has. This credit is subject to phase out, so you want to see example 7-23 on page 7-31. Next, we want to look at some of the refundable personal credits. Earned income tax credit. Earned income credit, or EIC, is a refundable credit to offset the employment taxes on earnings of low-income taxpayers and to encourage employment seeking. The credit is available for qualified individuals with earned income for the year. Excess EIC is refunded if EIC is greater than regular tax amount. The difference is refunded to taxpayer. Taxpayers may claim EIC if these conditions are met. Number one, an individual who has at least one qualifying child. Number two, they are non-dependent taxpayers who between 25 and 65 who live in the U.S. for greater than half a year, even without qualifying child or children. Number three, passive income, capital gains, interest, dividends greater than 3,350 disqualify for EIC. So the amount of the tax credit depends on one, the taxpayer's filing status. Number two, the number of taxpayers qualifying children who live in the home for more than half the year. And number three, the amount of taxpayers' earned income. To be eligible for the credit, married taxpayers must file a joint tax return. For this one, we want to look. We have a Exhibit 7-10, this EIC table, and also example 7-26 on pages 7-33 and 34. So here, let's look at this table. You don't really memorize it, and it's readily available. You can just go on to the IRS website. And also, there are other refundable personal credits, for example, partial tax credit, child tax credit. Number two, excess FICA withholding, and also taxes withholding on wages and estimated tax payments. For the excess FICA withholding will happen when an individual has worked for more than one employer, and each employers will take the amount of deduction based on the tax rate of FICA. So a person only allowed to pay so much FICA in a year, so any excess that will be refunded to the taxpayer. What about business tax credits? These credits are non-refundable, designed to stimulate employment and encourage research and development activities. When business tax credits is greater than taxpayers' annual gross tax, the credits can be carried over 1 year and carried back 1 year and forward 20 years when taxpayer has sufficient gross tax liability to use up the credit. And next, we will look at foreign tax credit. This credit is also non-refundable and may be limited if a taxpayer's earn this foreign tax rate is greater than the U.S. tax rate. When taxpayers pay income taxes to foreign countries for the U.S. tax purposes, they may treat the payment in one of three ways. Taxpayers may, one, exclude the foreign earned income from U.S. taxation. Number 2, include the foreign earned income and deduct the foreign taxes paid as itemized deductions. Or number 3, include the foreign income and claim a foreign tax credit for the foreign taxes paid. When the use of a foreign tax credit is limited, taxpayers may carry back their unused credits 1 year and carry forward the credit up to 10 years. This one you want to see Exhibit 7-11, page 7-36 for summary of selected tax credits. When taxpayers have multiple credit types in the same year, they apply the credits against their gross tax in the following order. Number 1, non-refundable personal tax credit. Number 2, business credits. Number 3, refundable credits. The sequence maximizes the chances that taxpayer will receive the full benefit for their tax credits. For this one, you want to see Exhibit 7-12 on page 7-37 for the credit application process. So for this learning objective number 4, we discuss all different kinds of tax credits, whether refundable or non-refundable, and under what circumstances can taxpayer take these tax credits. Please post your questions under virtual office or discussions for the chapter this learning objective is assigned. Thank you.